My name is Peter Schaffrik. I'm responsible for European macroeconomic and fixed income strategy at RBC here in London. Welcome to the first video, what hopefully will develop into a series covering important macroeconomic trends and key developments for Europe and their impact on financial markets. Today, I want to talk about one of these key developments, the so-called European Recovery Fund. Since the marathon meeting between European leaders, a lot has been said about that novel fund. Some commentators are hailing it as a Hamilton moment, others are rubbishing it for being once again too little, too late. As always, we think the truth is likely somewhere in the middle, and we certainly think that this novel creation will leave its imprint on financial markets for years to come. Today, I would like specifically to talk about three key aspects of the fund. First, the fund creates a transformation over time. Secondly, the fund creates a transformation over geography. And thirdly, the reduction in size compared to the initial proposals should not worry markets too much. So first of all, the creation of the so-called European Recovery Fund not only allows, but also gives the EU as an organization a mandate to go out for the first time in its history and fund through financial markets in debt. The proceeds will be used to fund investments in the here and now, but the repayments shall only be made from the year 2028 to 2058, so a very, very long maturity. So this implies a substantial transfer in funds from the future into the here and now, or in plain English, borrow and spend policies that usually are the sole domain of member states. Now, in the process, the EU will create a AAA rated safe assets of non-trivial quantities, up to 750 billion, but we estimate around 600 to 650 billion that will be around for decades. And that's something that the investor community has called for years. And this transformation over time, this borrow and spend policy, will benefit all countries during the time of the payout, but particularly the more economically challenged ones. As an example, Italy typically pays about 5 to 6 billion into the EU budget over the last couple of years. We estimate that the allocation of the recovery fund into Italy will leave the Italian budget at about 12 to 13 billion of net recipients. So that's a turnaround of about 1% of GDP for 4 to 5 years running. You can see this in the chart as the difference between the dotted lines and the colored lines. This is meaningful in economic terms, if the money will be well spent, but also will be politically important, particularly in those parts of the EU where anti-European parties have made huge landfall over the last years. It will be much harder in the future to argue that the EU does not do anything for your country. And in turn, it is thus likely to reduce the market-implied breakup risk substantially. Secondly, there will be a transfer by geography. As I just elaborated, the EU will raise debt and will distribute those funds to all its member states, some in loans and a good part in grants, around 390 billion. Yet, when the debt will be repaid, it will be the more prosperous, typically Northern European states, that will pay back more than they received in the first place, while the Southern and Eastern Europeans, they will be net recipients, i.e. pay back less than they were allocated. And this redistribution is also politically contentious, of course, and is one of the main reasons why the agreed amount was smaller than the originally proposed 500 billion in grants. Yet, we still think it's a healthy sign to the market that the EU as an organization is able to support each other. And whilst we strongly argue that the transfers over time are more important economically than the transfers over geography, the fiscal transfers are also politically important for the same reason as I mentioned earlier, by hopefully reducing the breakup risk. Thirdly, what about the total size? As has been well publicized, the agreed amounts of 750 billion now contains only around 390 billion in grants, compared to the 500 billion proposal initially. This has led some observers to dismiss the plan as somewhat falling short. Yet we think a look at the details is really important here. It is worth stressing that the package is actually not one package, but a whole series of packages, with the lion's share going to a genuinely new Recovery and Resilience Facility, or RRF for short. Yet, in the initial proposal, there was also a host of already existing programs that were initially proposed to be topped up. And it is here where the reductions came, in the top-up of already existing programs. The key new RRF, however, was increased. And this is important because economically speaking, we think that the reduction in the top-ups will not mean a cancellation of the programs over the coming years. They are going ahead as planned anyway. Yet the key additional spending is likely going to come through this RRF, this novel facility, which foresees all sorts of investments ranging from education over health to green and digital investments. So in short, we think the reduction in size of the grants is unlikely to reduce the economic impact much. Lastly, let's talk about the market impact. We've already seen a sizable contraction in spreads in the euro market, ranging from sovereign to corporate credits. This is not only due to this fund, but also due to this fund, and we think it will continue. Secondly, we know that there is a huge discount for European risky assets relative to particularly the US. That is likely due to underinvestment in European assets, and we think that this fund will contribute to some reversal thereof. Thirdly, we've already seen a sizable move in the euro. A good part of that is due to the weakness in the dollar, but some is also own euro strength. We think this will continue and will play out particularly against sterling, where intrinsic weaknesses for the UK are going to come through in the second half of the year. That's likely going to be a story for another video, and I hope you will join me again when we record it. Thank you very much.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.